Hi, it's Nero here from Investment Rise, and over the last couple of weeks we've had a number of people snap up the opportunity to have a free strategic consult with us to help them invest in property. And one of the questions that many of them have had is, look Nero, we understand that the Sydney and Melbourne markets are falling. We understand though that those markets are not going to crash despite all this sensationalistic journalism that's out there, but at the same time buying in Sydney and Melbourne isn't really going to give us a lot of capital growth over the coming few years. So the question that we have is, should we even bother investing? Should we maybe just look to put our money in the bank because we know that interest rates will rise over the next little while, rather than maybe to look for an investment property outside of Sydney or Melbourne, some of the markets that you talk about? I thought that was a really good question because in fact one of the people I spoke to actually said, Nero, imagine if interest rates rose to say 5% for example, how would that work in terms of having money in the bank? So what I want to do here is actually go through an example just to show you all the things you need to consider when you're looking to decide whether you should keep your money in the bank or buy an investment property. So let's say, for example, you have $120,000. All right, $120,000 in the bank, and let's say interest rates do rise to an interest rate of 5%. Okay, so that means after 1 year, if you keep $120,000 in the bank, after 1 year you make an additional $6,000. Okay, which means you now have $126,000, and of course there is some tax to pay on this, less tax, but we'll just ignore the taxation component for this example. Okay, so now mind you, interest rates in the bank is about 2.5%, so half this. So I'm being very, very generous to look at what the interest rate is for banks. But let's look at that in terms of interest on savings. Now, what happens if you take that same $120,000 and put it into property? Well, with $120,000, you could take $100,000 and that would form your 20% deposit. And so you could use that to maybe buy a $500,000 property, and your extra $20,000 would be for your stamp duty and legal. So put simply, your $120,000 could result in an investment property of around about $500,000. Assuming, of course, you've got the borrowing capacity for that, which is obviously something that we're assuming in this case. So you have this $500,000 property. Now let's just say it also goes up by 5%. Okay? Well, what's 5% of $500,000? Well, that means in this case you have made $25,000 less, again, tax if you choose to sell. Okay? But remember, you only put in $120,000. So how much return have you actually made? Here you've still made a 5% return on your investment in cash, but on your investment in property, even though the property rose in value, you've made, what are we talking about here? 10% is 12, so you've made over 20% return on your investment. Why? It's because you're using the power of leverage. And this is one of the key secrets, and many people don't fully comprehend, is that when you're looking to invest in property, even with all the lending regulations and APRA making it tougher and all of that happening right now, the fact that you can still leverage, maybe not leverage as much, but the fact that you can still leverage allows your money to work harder for you. So rather than just keep the money in the bank and assume you can get this great interest rate, and look what I've done here, I've actually assumed that property prices rise in value by the same amount of interest that you get in the bank. And you and I both know that is not the case. At the moment, banks are giving you far less than 5%, and in some of the markets that we're looking at, prices are rising by more than 5%. But I've just made it even, just to give you a scenario that even if the return was the same high level, you still make more money from an investment in property. Now, of course, though, when you're looking to leverage, you're taking on debt. And the question then is, well, what about that? How is that going to affect our lifestyle? Don't we have to take into account the cash flow considerations? And you do, right? So assuming, first of all, you've got the borrowing capacity, the second thing you then want to make sure is that whatever you're borrowing to go from the $120,000 to securing the $500,000 property, that interest amount and all the costs that come with investment property, you want to make sure that you're doing your cash flow numbers such that when you buy this kind of property, the rent plus any depreciation if you're looking for a brand new property, all that covers your costs. So therefore, from a day-to-day perspective, from a cash flow perspective, there should be no difference between option A, which is cash in the bank, versus option B, which is buying an investment property. So all we're saying is you're taking your $120,000, you either keep it in the bank and hopefully make a 5% return, or you buy an investment property and you could make over 20% return on your money. All right. So this is why when we look to invest in property, when I talk about safety first investing, we want to see, well, what's the capital growth prospects? How easy is it to get the property rented? What's the net cash flow position for you? Because if the net cash flow position means that your lifestyle isn't impacted, then you're essentially just getting your money to work harder for you. You're just taking your money out of the bank, putting into a different asset class. So in this case, an investment property, such that you're making more money without working any harder. Of course, this isn't financial advice, and you need to obviously look to your specific situation. There are certain other things that we need to consider. And obviously there's no guarantees here, but even in this completely absurd situation where property is rising by the same amount of rate of return rather that the bank is giving you, you still come out ahead in property. Now imagine, for example, if you get more than 5% here, maybe you get 10% growth in property. All of a sudden your returns get that much more. And remember, today we're finding properties where the cash flow is not only covering the mortgage, it's giving you more. So literally I was speaking to a client who had this question, and once I understood the power of property, I then showed them two different types of property. One property was positively cash flowed by $14 a month. Okay, so that's hardly anything, but it meant that their lifestyle wasn't impacted. The property covered the interest costs, it covered all the rates and maintenance, everything, and still came out $14 positive. Whereas I showed them slightly different property, and it came out $250 positive per month. So you can certainly look at that and go, well, there are certainly some great options out there if you're looking to invest, if you want to get your money to work harder for you. And that's really why I guess the aim of this video is to show you that even when you look at money in the bank versus buying a property, the same rate of return, because the power of leverage and done correctly and safely, you can come out ahead many times you look to buy the right type of investment property. Look, I really hope this video helps, and if you feel that it can help someone else who's just not sure about whether they should invest, they're worried about the debt and they're not sure whether they should just keep their money in the bank versus invest, please share this video with them. Otherwise, I look forward to speaking to you soon. Bye for now.